Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane. This week, we're discussing the advantages and disadvantages of filing married filing separate versus married filing joint. At Spidell's Federal Tax Update webinar, you'll get updated on everything that happened during the year, including TCJA provisions that expire at the end of 2025, beneficial ownership reporting requirements, the latest research credit developments, using AI in your tax practice, and more. Get details and register at spidell.com. The general rule is that married taxpayers who file jointly fare better tax-wise, but that's not always the case. It may pay to examine your married client's situations to see if they might be better off filing a married filing separate return. The biggest advantage to filing separately is that it may, but doesn't always, mean both spouses' income is taxed at lower rates, but there's frequently a cost in terms of lost tax benefits. The only way to truly determine whether married taxpayers are better off is to run the numbers as if the spouses filed jointly and then separately and compare the results. Here are situations where it may be advantageous to file separately. File separate returns if your client is concerned about accepting full liability for any taxes owed, now or later, as the result of a tax audit. Don't leave your client holding the bag for a spouse who underreports income or overreports deductions. If one spouse owes back taxes from before the marriage, back child support payments, or unpaid federal student loans, filing a separate return may keep the non-debtor's tax refunds from being taken by the IRS or another agency for the other's old debts. File separately if the client's state imposes a higher tax on wealthy individuals. For example, California imposes an additional 1% tax on taxpayers with taxable income in excess of $1 million. And New York increases its tax rate by almost 3% for taxpayers with income in excess of $1,077,000, and even more for taxpayers with income in excess of $5 million. Taxpayers who live in community property states will need to evaluate whether filing separately will help avoid the higher tax rate. State laws have no direct impact on federal tax laws, so why do state community property laws and other similar state laws matter for federal tax purposes? The answer is subtle, but important. A taxpayer's federal tax obligations are determined solely under federal law, but a person's property rights are determined under state law. In situations where federal tax law looks to a taxpayer's property rights first before applying federal tax law, a state's property rights laws will come into play. Areas of state law that determine property rights include, among others, community property laws that define property rights between spouses, real estate laws that determine the rightful owner of real property, such as the death of a joint tenant or a tenant in common, and corporate laws that determine whether an entity has been organized as a corporation, LLC, or partnership, etc. However, there are disadvantages to filing separately. Married taxpayers who file separately generally cannot claim the following tax benefits: the Earned Income Tax Credit, the Dependent Care Credit, the American Opportunity Tax Credit or Lifetime Learning Credit, premium tax credits, unless the taxpayer is a victim of domestic abuse, the deduction for student loan interest, the partial Social Security benefit exclusion, the standard deduction if their spouse itemizes their deduction, because both have to itemize if one spouse itemizes, and any exclusion of interest on Series EE or U.S. savings bonds used for higher education expenses. Also, if the married taxpayers are living together and file separately, they cannot claim the $25,000 passive activity loss allowance for rental property or the credit for the elderly or disabled. They also could lose all or part of their IRA deduction because the AGI phase-out amount starts at $0, and it completely phases out at $10,000 for separate returns, and the taxpayer is considered covered by a retirement plan if the spouse was covered. They also could lose all or part of their IRA deduction because the AGI phase-out amount starts at $0, and it completely phases out at $10,000 for separate returns, and the taxpayer is considered covered by a retirement plan if the spouse was covered. Spidell's Federal Tax Letter is a monthly newsletter plus a searchable online archive of back issues that keeps you at the leading edge of the federal tax issues that will impact your clients, from healthcare to trusts, and from energy tax credits to virtual currencies. You can see subscription information and download a sample issue at Spidell.com under Publications. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.